Some investors are saying there's a bubble right now. My next guest told me on this program back in June that he did think there was a bubble in U.S. Treasuries. He's Morningstar's Bond Fund Manager of the Year last year. Dan Fuss joins us now from Boston. So, Dan, you said in June there was a bubble in Treasuries. What are you thinking these days?
Well, I'm thinking the same thing, except I'm watching my words more carefully, Margaret. I never should have used that word because it isn't quite accurate. What you have had all through this, and this actually started in the fall of '08 where we had a spike upwards in Treasury bond prices, and they dragged along high-quality mortgages, Ginnie Mae's, stuff like that. Everything else just went down on quoted value because there was no bid in the market. This one is very different. We're getting another spike in Treasury bond prices, but it's dragging everything along with it because there is liquidity in the markets, and in general, you know, there's a favorable, at least as far as corporate earnings, a favorable business outlook, not in other respects. So it's very, very different, and it doesn't mean that it's any different from a valuation basis. I think Treasuries are overvalued.
Okay, so overvalued, overbought perhaps. Do you still like them better than other reserve currencies?
Well, do I like the dollar better than other reserve currencies? The answer is yes. Do I like Treasury bonds versus other bonds denominated in dollars? The answer is no. No, not at all. I think they're grossly overpriced relative to other U.S. dollar pay bonds.
Okay. Kip Condron is here. He wants to ask a question of you, Dan.
Yeah, I'm a little curious. You know, taking a longer-term view, and you surely have, you know, the perspective and the history of going back into the 70s and riding the inflationary wave, and then this 28 or so year bull market in bonds. As you look forward, do you think that this interest rate phenomena can last? I mean, you know, as we're looking out over several years, think about someone planning for their retirement. You know, locking in the 10-year Treasury today at 2.5% for 10 years. Is that a smart move?
No, I don't think so. It's you know, as you know as well as I do, it's guesswork. In fact, oftentimes looking at where we are today is guesswork. Looking forward is guesswork. My guess on this is that at some point in the not too distant future, let's say 2 years from now or less, you're going to start to see an updrift in interest rates led by heavy-duty financing by the U.S. Treasury. Now, if I'm wrong on my guess about the Treasury borrowing requirement going forward, that could be quite something else. But my underlying guess here is that it's going to be a long, long time until the Treasury borrowing requirement gets down to, say, 1 or 2% of GNP. I'm thinking 4% or more. I hope I'm wrong. Yeah. But I don't think so.
Do you still like corporates in the lower grade area? Are you still finding opportunities there?
Yeah, here and there. I mean, we were all spoiled 2 years ago or even a year ago by what was available at that time. The average corporate bond, statistically, you say, I don't know. But you can find exceptions. They're not huge. And normally when you do have the exceptions, you have a different view of what's coming on the credit side. Okay. That's the way it looks to me.
All right. That's where you're finding places to put your money at the moment.
Yeah, here and there.
All right. Thank you, Dan. Always good to speak with you.